Hi everyone, welcome back to the channel. Today we will dive into the market performance of the S&P 500 index this week, unpack the impacts of the recent tariff announcement on the stock and bond markets, and I will share my personal investing moves during this volatile period. But as a disclaimer, this content is for educational purposes only and should not be taken as investment advice. Always do your own research before making any financial decisions. So let's jump in and start by looking at the trading view chart to see how the market performed this week. I'm recording this video on the 11th of April, and it's a Friday. The US markets have just closed, and you can see that this is the S&P 500 index, which is 500 companies that are actually publicly listed and that come from different sectors. But you can see that this is a daily chart, and I'm gonna see if I can just change this to a weekly time zone. But you can see that what's been happening in this market, it has been very difficult to predict. You can see that if you look at even today, it was like very volatile. This is how traders make money. You buy here, you sell, you buy here, you sell here. But what you see here, these are the demand zones, supply zones, and in technical analysis, supply zones, these ones are in red, and demand zones, these are levels where buyers are actually in control, so they can actually push the price up, and supply zone sellers are in control. So if I like to look at, let's say, the daily chart. You can see that if I zoom out here, this is when the tariff announcement was made to pause the tariff by the US administration. So the S&P 500 jumped by the S&P 500 index. It went up by 10%, right? So indicating that people were kind of like really expecting that this, at least for the next 90 days, this uncertainty was going to go away. And I'm going to share more about my thoughts about the bond market. But you can see today the market just closed. Most of the US tech stocks, they were green. And you can see that the VIX dropped. Usually there's an inverse relationship. If the equities market is going up, the VIX is usually going down. And at the end of the day, this is something that is interesting. If you were to look at this data, last week, most people who were trading on margin, they received some margin calls. In other words, if they were borrowing because their portfolios were really, really down. Now, this is something that is interesting in the sense that when we look at this rally that happened, about $4 trillion in value to the US stocks was added midweek. And before the next day, the market dropped. So what that means is with that volatility still remaining high, as shown on the demand and supply zones in the chart that I showed you, the market is still digesting these policy changes, and uncertainty is keeping traders like me on the edge. Now, it's important to emphasize that when I'm trading, I look at both fundamental analysis because I like to trade stocks that have wonderful, good fundamentals. And I also want to look at the economic data. That kind of like gives me the picture of what's happening in the inflation or job numbers, because they kind of like have an impact on how investors and traders react. Now, if you look, I'm gonna put the chart here for you to see that I got on trading on investing.com. Core CPI month on month, it came down at 0.1% below expectations, and it indicates that inflation might be cooling slightly, which is positive for consumers, but it raises questions about the future of the Fed policy. Now, initial jobless claims were in line with forecasts at 223,000, signaling a stable labor market despite broader economic uncertainty. The producer price index, PPI, dropped by negative 0.4%, which could suggest easing pressure for businesses. But for investors, this mixed data means we are having to navigate a delicate balance between inflation concerns and economic growth. Now, moving on to the impact of tariffs on the market. The big story this week, like I shared with you, was that the tariffs were paused for at least for the next 90 days at that time that announcement was made, and the ripple effects are already visible across the financial markets. And like I indicated, that volatility was elevated, and investors still continue to try and grapple with what this means. And Bloomberg reported that the bond and the currency markets have been particularly unstable this week. And I was also reading an article by Paul Krugman, who is a very notable economist, indicating that usually the currency and the bond market, they've been the beacon of stability. So once you see volatility in those particular markets, because usually central banks, governments, and other investors with a lot of money, they choose treasury bills as a safe haven. So now if there is uncertainty, what that means is that some investors, as reported, the euro has been appreciating versus the US dollar. So what that means is more money is now going to the euro, right? Usually investors tended to go to the US dollar as a safe haven or to gold, even though gold is still went up this week to record high. But now more investors, from what I see, or I would say money is flowing to other stable markets like the European Union. And the 10-year yield, it was rising above about 4.5%, its highest level since February. And I indicated this reflects reduced demand for US government debt as investors grow cautious about US fiscal stability amid trade tensions. Now, for traders and investors, this means that it is very, very important to manage risk, to navigate volatility carefully whilst staying focused on long-term goals. Now, my investing moves this week was very volatile, like I've admitted. Even for me personally, it still nonetheless presented some opportunities. I added more shares to my long-term portfolio in companies I believe in, including Microsoft, Booking, Mercado Libre, Apple, and JP Morgan. These, in my view, are high-quality businesses that I think are trading at an attractive price, and they've really retraced to actually a huge discount in terms of my valuation. Again, this is not an investment endorsement. This is just me doing what I'm comfortable with. I also wrote covered calls to generate income for my holdings, a strategy that has worked well for me despite these market swings. And I've explained what covered calls are on this channel. That said, I also made a costly mistake earlier this week that could have resulted in 100,000 Canadian dollars loss. Thankfully, I managed to recover and ended the week profitable. And I did a video to share my experience and what actually happened for me to almost make that mistake that could have almost ruined my portfolio in a way. Now, the lessons that I've learned are that time in the market beats trying to time the market. Missing just a few of the best trading days can significantly impact your returns over time. Just imagine if you were not invested, right? The S&P 500 rose by 10% and dropped, let's say, by 3%. Still, there's a 7% upward movement. And today it went up by 1.78%. What that means is still, if you missed out now, you could be getting in at the top. That's what this idea of trying to make sure that your dollar cost coverage only in fundamentally strong businesses and things that have been shown to appreciate in value over time. And again, a caveat there is that the past does not necessarily guarantee the future return. So you must always understand the macroeconomic environment, what you are investing in. Now, Opportunities amid this uncertainty are abound, in my view. While volatility can be nerve-wracking for sure, it also creates opportunities for disciplined investors, even traders alike. For long-term investors like me, this is a chance to buy wonderful businesses at discounted prices. Companies like Apple, Microsoft have strong fundamentals. I was looking at even Amazon having like 100 billion in cash and cash equivalents, right? And companies like Berkshire Hathaway having like 300 billion in cash and cash equivalents, right? So those are companies that even if things can continue to be worse and worse, I believe they would still withstand those market volatilities. And even for me, I'm looking to actually add more shares if this volatility continues to push the prices of those stocks down. Now, for traders, strategies like vertical spreads can be turbocharge returns, can help turbocharge returns while managing risk in uncertain times. I've done videos to explain vertical spreads, for example, vertical call and vertical put spreads as well. So if I'm bullish, I would do vertical call spreads. And if I'm bearish, in other words, I believe that the market is gonna drop, I would do vertical put spreads. But at the end of the day, you really have to understand the technical and fundamental analysis. But sometimes even with this news that comes in like this, you really have to understand how to hedge the portfolio, because things can happen anytime and you might potentially lose a lot of money if you don't really have a trading or investing plan. Remember, investing is personal. It comes with risks and rewards unique to each individual's goals and risk tolerance. To wrap up, the S&P 500 has had an eventful week with significant gains despite ongoing uncertainty around tariffs and trade policy. Bond markets showed signs of stress as yields surged, reflecting investor caution. Personally, I use this volatility as an opportunity to build my portfolio and generate income through options strategies. If you found this video helpful, don't forget to like, subscribe for more market insights. If you are interested in learning how to trade or invest, book a one-on-one coaching session with me at www.streetwiseeconomics.com. Until next time, trade and invest wisely, and may the markets be on your side always. Thanks for watching, happy investing, and see you next time.